The geopolitical world looks scary, but economically, it's blue skies. We'll have a quick look at the global influences and their impact locally. It's a good news week for now, so let's take that for as long as it lasts. Despite volatile words on the political and international security side, most major economies and emerging markets are actually doing pretty well, as are stock markets. And certainly much better than they looked 6 months ago. So the trend from surveys and sentiment indicators is generally pointing in the right direction, which points to the more supportive nature of global markets, helped by ongoing low interest rates and lessening fears about Europe and China in particular. The European outlook is perhaps the biggest surprise, given its checkered performance since the GFC and its own political risks. So it's good to see the European, US and Japanese growth rates are converging. For us here in Australia, the Chinese soft landing and associated rise in steel and commodity prices has been the best news of all. So, as our Reserve Bank noted in its latest statement on monetary policy, the recent recovery in global trade is in direct response to a pickup in global demand, both via commodity and other merchandise exports. As a result, domestic conditions have benefited from this, with the only real downside being the higher Aussie dollar. Regular viewers of this update would be aware we've been calling the Aussie high for some time, based on expected US dollar weakness, more so than domestic strength. So the rally to over 80 cents was no great surprise, even though we're all aware the RBA would prefer it were lower, and our broader economy is challenged by a stronger currency, with the negative impacts on tourism, exports and lower inflation. From here, we see a dip to the mid-77s as being possible, but we're still wary of a weaker US dollar further down the track, which can take us back to above 80 cents once this dip bottoms out. And we do continue to expect the iron ore price to do well, in line with the Chinese outlook. Overall, business confidence and conditions are maintaining their strength locally. And while consumer sentiment isn't quite keeping pace with business, the jobs outlook is relatively positive. Inflation and growth have been slow but are likely to edge higher, and the housing market seems to be coping with macroprudential limits and lower wages growth. The variations from city to city and region to region are sizable, and building approvals have been falling for 9 months now. But the key is avoiding a hard landing, so the benign inflation outlook should keep interest rates low, and the ongoing jobs growth suggests the economic blue skies are fairly well entrenched, barring a geopolitical shock from overseas. Until next time, that's the market update from Bendigo Bank.